So now that we know what is a finance lease, it is time to see the detailed accounting of finance lease in the books of the lessor. What is the guidance given in Ind AS 116 for the accounting of a finance lease? Let's go through that. Yeah, what Ind AS 116 requires is, it says that at the commencement date, a lessor shall recognize assets held under a finance lease in its balance sheet and present them as a receivable at an amount equal to the net investment in the lease. So you are basically supposed to determine the net investment in the lease. How shall that be done? They are saying net investment in lease is gross investment in the lease discounted at the interest rate implicit in the lease. So basically, if I use a short form, net investment in the lease will be equal to present value of gross investment. So if you have a finance lease, you are supposed to determine the assets held under finance lease and present it in the balance sheet at an amount which is equal to the net investment in lease. So obviously the question is, what is the net investment? Net investment is present value of gross investment. So we still don't get the answer till we do not know what is gross investment. Okay, here it is, the gross investment. Gross investment in the lease is the sum total of lease payments receivable by the lessor under finance lease and any unguaranteed residual value accruing to the lessor. In the earlier episode where we were discussing that how we can work out the interest rate implicit in the lease, at that time we had seen to a certain extent the gross investment. We are saying gross investment will be equal to lease payments plus unguaranteed residual value. Okay, residual value is basically getting segregated into two: guaranteed residual value and unguaranteed residual value. Guaranteed residual value is that portion of the residual value which is guaranteed by the lessee or maybe an agent of the lessee. Any residual value over and above the guaranteed residual value will be understood as unguaranteed residual value. Something in this way. Think for a moment. Let's say you are a lessor, you are entering into a 10-year lease. Okay. And at the end of the 10th year, asset is returned by lessee. Asset is returned by lessee. And then we will sell it. We are of the view that the residual value that we will get, right? We are of the view that the residual value that we will get is 30,000 rupees. Okay. Now, lessee, let's say, lessee has given a guarantee. Lessee has given a guarantee that, see, after 10 years, when I will return back the asset, you will definitely get 25,000 rupees. So, understand, 25,000 is an amount guaranteed by the lessee. It's a 10-year lease agreement. At the end of the 10th year, the asset will be returned back by the lessee. Lessee is guaranteeing to you today itself that, see, when I will return back the asset will be definitely worth 25,000. So 25,000 is a guaranteed residual value. But I am a lessor. I have done these kinds of transactions many a times earlier. See, a lessor has a business of leasing out the asset. And I know that when you will return back the asset, although you are guaranteeing 25,000, but I know from my past experience that when I will sell this asset, I will get 30,000. So total expected residual value is 30,000. Out of that, 25,000 is guaranteed by the lessee. So I am expecting another 5,000. This extra 5,000, it is not guaranteed by the lessee, but I know I will get. This is what we are referring as unguaranteed residual value. So we are getting this as, right, this 5,000 which I am expecting, not guaranteed by the lessee, but I am hopeful that I will get this. This is what I am referring as the unguaranteed residual value. So basically, residual value will be equal to guaranteed residual value plus unguaranteed residual value, isn't it? Guaranteed residual value 25 plus unguaranteed residual value 5, total 30,000. Okay, guaranteed residual value becomes a part of the lease payments. You may of course always wonder that why are they saying lease payments receivable? I'm talking about this point. You may wonder that why are they saying lease payments receivable over here and then adding unguaranteed residual value? Why don't we add directly the entire residual value? The reason is that lease payments already includes guaranteed residual value. So any residual value over and above the guaranteed residual value, which is the unguaranteed residual value, that is what we are separately adding. So that is what becomes the concept of the gross investment. So the whole thing is moving in this particular way. We say gross investment. Understand this now really well. We are saying gross investment is equal to lease payments. Right? To make it simpler, we say lease payments receivable, because lease payment is something that will be paid by the lessee. The lessor will receive it. So we say lease payments receivable. So gross investment will be lease payments receivable plus unguaranteed residual value. Unguaranteed residual value. In case if you are wondering where is the guaranteed residual value, please understand the guaranteed residual value. Understand this. The guaranteed residual value is already lying in the lease payments. Okay, it is already included in the lease payments. Unguaranteed residual value, lessee has not guaranteed it. So this is something that we will get extra. So separately we are considering it. Okay. Now what you should do is, there is interest rate implicit in lease, right? There is interest rate implicit in lease. This interest rate implicit in lease, you should use as a discount rate. You should use as a discount rate and find out what is its present value. Find out what is its present value. Present value of gross investment. Okay. Present value of gross investment is net investment. And this net investment is what will be ultimately recognized in the balance sheet of the lessor. If you again see the whole thing, what they are saying is, the first para, if you just go through it, they are saying that a finance lease will be presented as a receivable at an amount equal to net investment in the lease. Net investment is present value of gross investment. See, gross investment in the lease discounted at the interest rate implicit in the lease. So present value of gross investment is net investment. And what is gross investment? Gross investment, lease payments receivable and any unguaranteed residual value. So naturally now a question arises that what exactly are the lease payments? So that's the clarification now over here. We are now discussing how shall the lease payments be determined from the viewpoint of the lessor. Okay, from the viewpoint of lessor. We are segregating that into inclusions and the exclusions. So what are the inclusions? Just see. Inclusion, they are saying same as for lessee. Oh my God, this is really a very nightmarish situation as far as a teacher is considered, because you are saying same as for lessee. If you do not remember what is there for lessee, if you have already forgotten over the course that what was the case of lessee, then it is going to be really tough for me as your teacher, because what I'm saying is that the lease payments from the viewpoint of the lessor is the same as for lessee. So we'll have to revisit that what is it from the viewpoint of the lessee. The only thing is that now the discount rate shall be interest rate implicit in lease. Okay. Same as for lessee. Here is the reference that I am giving you now. This is something that we already discussed earlier. These are the lease payments from the viewpoint of lessee. Remember now, from the viewpoint of lessee as well as from the viewpoint of the lessor. We realize that now, isn't it? Lease payment concept is the same from the viewpoint of lessee and the lessor, except for one difference, and that is with respect to the discount rate. Okay. Very quickly, we have already discussed at a great length, and then we have solved quite a few questions also. So you know it very well. What are the inclusions? Don't read the exclusions. Okay, exclusions for the lessor will be different. We are talking about the inclusions, right? Inclusions, fixed payments. I'm sure you will be able to recall now. Fixed payments including non-refundable taxes. Okay, that is something which is a lease payment. Understand what the lessee will pay. It's a very logical thing. What the lessee will pay, lessor will receive. You may wonder that why is it the same for lessee and lessor? It has to be same for lessee and lessor. Whatever the lessee will pay, the lessor will receive. That's the reason we are saying that the lease payments from the lessor is the same as from the viewpoint of the lessee, isn't it? So fixed payments will be considered, yes. Variable payments that depend on an index or a rate, anything that is linked to the consumer price index, anything that is linked to a rate like LIBOR, right? They are all included. Then the third item, exercise price of purchase option, if the lessee is reasonably certain to exercise that option. Fourth item, payment of penalty for early termination of the lease contract if the exercise of that termination option is reasonably certain. But look at the last item. Look at the last item. See, just read it. Yes, guaranteed residual value. You get my point. What I am trying to say is that when you calculate lease payments, it includes guaranteed residual value. That is the reason Ind AS 116, when it coins the concept of gross investment, it says lease payments plus unguaranteed residual value. So here it says unguaranteed residual value for a simple reason that guaranteed residual value is already included in the lease payments. Then the extra amount that you may get, that is to be included. Unguaranteed residual value will not be paid by the lessee. So when we discuss it from the viewpoint of the lessee, we ignore it. You will return the asset back to me. Let's say you are a lessee. You will return the asset back to me. I will sell it for 30,000. You have guaranteed 25. The extra 5 you are not going to pay. Lessee will not pay, but the lessor will receive. And that is the reason we are including it in the concept of the gross investment. Comfortable? Okay. Fine. So that were the inclusions. And what about the exclusions now? Just see exclusions. Again, 1 and 2 from the lessee. Okay. So again, I take you to lessee. Payment towards asset maintenance, repair, insurance, common area maintenance, etc. These are payments which are being made towards a service and not towards the asset. So they are excluded. They are excluded for lessee. They are also excluded for lessor. Okay. Variable payments that do not depend on index or rate. As a lessor, I am suggesting to you that see, whatever is your sales, 1% of sales also you have to pay to me. Now this is a variable payment. Sales will fluctuate every year. 1% of that will also fluctuate every year. So it's a variable payment. And it does not depend on an index. It does not depend on a rate. And that is the reason this variable payment will not be included in the lease payments. It will be excluded. It will be excluded for lessee. It will also be excluded for lessor. So we will be excluding this for the lessor. And then they are saying over here, they are saying 1 and 2 above shall be separately recognized as an expense. This note was from the viewpoint of the lessee. So we were saying it will be recognized as an expense. If any portion of this is received by the lessor will recognize it as an income. Okay. So if you see here 1 and 2 from the lessee, and then it says above shall be separately recognized as an income in statement of profit and loss as and when earned. I am demanding 1% of sales as a payment. You will pay that to me. It was not a part of the lease payments, but this is of course an income for me. I will credit it to my profit and loss account. And then yes, there is one place where the accounting of the lessee and the lessor will differ. And that is with respect to point 3 over here in the exclusions. Many a times in a lease agreement, you may have a lease component as well as a non-lease component. For example, the lessor is giving you a package deal. Let's see, you can use the asset and I will also provide the maintenance service. So when lease rent is paid, the lessee is paying towards the asset, the lessee is also paying towards the maintenance. Whatever you are paying for the asset is a lease component. Whatever you are paying for maintenance is a non-lease component. So you are supposed to carry out an allocation of the total lease payments. The total lease payment has to be allocated into lease component and non-lease component, right? However, Ind AS 116 gives what we call as a practical expedient. Practical expedient means we are giving, for the purpose of convenience, an option to the lessee that, see, if you do not wish to do this allocation, it is fine, no need to do it. So for example, I am paying a lakh of rupees of rent. I as a lessee, I know that some portion of that 1 lakh is towards maintenance service, but I do not want to do that segregation, right? I don't want that unnecessary complications are there in my accounting. I want to keep it simple. So Ind AS 116 says that you can do this as a lessee. No need to carry out this allocation. Consider entire 1 lakh as a lease payment, as if the entire 1 lakh is for the lease component, and carry out the entire accounting. The advantage over here is that that unnecessary hassle which was there, right, I am relieved of it. The disadvantage is that my lease liability will turn out to be on a higher side. But still, this practical expedient is available to me. If I have entered into multiple lease transactions, remember, it will make the life of the accountant of the lessee much simple. So this practical expedient is available, but remember, this practical expedient is available only to the lessee. If you are a lessor, you do not have this practical expedient. Okay, as a lessor, segregation of the total lease payments into lease component, non-lease component is compulsory. Okay, it is compulsory. So that's where there will be a difference. Just read the second point. Practical expedient available to lessee for non-allocation of lease and non-lease component is not available to lessor. So this advantage which was there, or instead of advantage, I may say this relaxation which was there for a lessee is not there for the lessor. Ind AS 116 argues that, see, you are a lessor, it is your business to lease out these assets, and because it is your business, it's a business model that you are following, you have to compulsory carry out the segregation of the lease payments into how much for the lease component and how much for the non-lease component. The relaxation available to the lessee is not available to the lessor, right? So now that we are clear with the basic concepts that we are going to follow, let's see how finally the accounting will be done. We are talking about initial measurement here. We are saying initial measurement for finance leases of other than those involving manufacturers and dealers. We are talking about a finance lease of anyone other than a manufacturer, other than a dealer. Okay, they are saying at commencement of the finance lease, lessor de-recognizes the carrying amount of the underlying asset. So the underlying asset has to be removed from your books. Okay, since you are removing it from the books, obviously the de-recognition will happen at the carrying amount. Then it says recognizes the net investment in the lease. Net investment in the lease, the present value of gross investment, and recognizes in profit or loss any selling profit or selling loss. Okay, so what they are saying is that you will recognize the net investment in the lease. So net investment in lease, this account will be debited. De-recognizes the carrying amount of the underlying asset. So we say to PPE, or it might be some intangible asset. Okay, and then whatever is this amount and whatever is this amount, the difference between these two amounts, that will be recognized in the P&L. If there is a loss, debit the P&L. If there is a gain, credit the P&L. So this is the work that is needed to be done. When, if you are a lessor entering into a finance lease, but you are not a manufacturer, you are not a dealer. If you are a manufacturer or a dealer, the treatment is different. Okay. Initial measurement, they are saying for finance leases of manufacturers and dealers. Okay. The lessor recognizes the C. Fair value of the underlying asset or present value of lease payments discounted using a market rate of interest, whichever is lower as revenue. If you are a manufacturer or a dealer and you are entering into a finance lease, you will have to recognize a revenue. Recognizing revenue means you have to treat finance lease as a sale transaction. When will you recognize revenue? You will recognize revenue only if it is a sale transaction. So here we are going to treat it as a sales. Sales will be recognized at lower of the two, right? They are saying whichever is lower. What? Fair value of the underlying asset or the present value of the lease payments. So you will work out the lower of the two figures and consider that as the sales. Okay. Cost or carrying amount of the asset less present value of unguaranteed residual value as cost of sales. Remember, revenue will be credited, cost of sales will be debited. And whatever is the difference between the two, okay, whatever is the difference between the two, that is your selling profit or loss in accordance with the policy for the outright sales. We are going to make a distinction over here between a finance lease entered into by a manufacturer or a dealer and any other lessor. We are making a distinction over here. Here, as you can see, the cost of sales, understand, the cost of sales that will be debited to revenue, this will be credited, and whatever is the difference between these two amounts, that's your profit or loss, which will be either debited to the P&L. If it is a loss, it will be credited to the P&L if there is a gain. So all these things are fine, right? The question that really arises in our mind is that why are we having this two differing treatments? Why are we distinguishing between a lessor who is a manufacturer or a dealer and a lessor who is other than a manufacturer or a dealer? Why this difference is there? Because at one case we are saying that you have to de-recognize the asset at the carrying amount, and in another case we are saying that no, you should consider this as a revenue, isn't it? While in one case we are saying we will recognize net investment, in the other case you are saying that no, there will be cost, and this cost of sales or cost of goods sold should be debited. And then we are calculating the selling profit or loss, which in both the cases it's been determined in a very different manner. So why this difference? Why are we distinguishing between the two types of finance lease? Okay, let's understand this particular point. It's very what I can say, quite simple. Only thing is it should really strike to us that what is the difference over here. Okay, we are talking about a lessor. Here we say other than manufacturer or a dealer, and here we say a lessor who is a manufacturer or a dealer. What difference will it really make? Okay, let's understand this point. Let us think for a moment that there is a company XYZ. Let's say there's a company XYZ. It is in need of 10 buses, let's say. It's a big company. Think in this way, it's a big company. There are a lot of employees who are living in different parts of the city. The company now intends that it wants to provide a bus service to its employees. And because it's a huge company and there are a large number of employees, it is in need of, let us say, 10 buses. These buses will ply on different routes and it will provide commutation services to its employees. So it wishes that these buses are running in every corner of the city on a particular route. Employees who are living in different areas of the city, they will board these buses and they will reach the company. And when the working hour ends, the same buses will again ply and will see to it that the employees are reaching their respective destinations. So for this, it needs 10 buses. It had made some calculation. It feels that 10 buses are required for this particular purpose. However, XYZ does not want to buy these 10 buses. Right? It is not a business of XYZ. It only wants a bus service. It is not interested in the bus itself. It wants the service. And that is the reason it wants to take these buses on lease. Let's assume that they will enter into a finance lease. Okay, the lessor will enter into a finance lease. So 10 buses are required. Now, what are the possibilities for company XYZ? What company XYZ does it contacts, think in this way, it contacts local transport company. Let us say there is a local transport company. It is, by local I mean it's a company which is there in this particular city, and it is known, it is very well known for the services that it provides. So it contacts a local transport company. This transport company is already owning, let's say it's already owning 100 buses. So it has a huge transport business. Its buses are running, for different destinations, and it is also providing buses on hire basis also. So it's already into this business of providing the transport services. So it owns 100 buses. Out of 100 buses, all that XYZ wants is that can you spare 10 buses for our purpose? Okay, so it is contacting a local transport company. And let us say this local transport company agrees, right? It agrees that, okay, we will provide you 10 buses on finance lease. It agrees that we will provide it on finance lease to you. Now, this is what we are putting in the first case. You are entering into a lease agreement, basically a finance lease agreement with a lessor who is not a manufacturer or a dealer. Now, what difference will it make over here? Understand, when you are contacting the local transport company and you are requesting the local transport company that is it possible for you to spare 10 buses for us, that local transport company agrees that yes, it's possible. We will spare 10 buses to you and we will provide this 10 buses to you on finance lease. When this local, this is the main point now, when this local bus enters into a finance lease agreement, it is entering into a finance lease agreement for an item of PPE. What I am saying is, ask yourself, okay, this company has 100 buses. This company has 100 buses. How will this 100 buses be shown in the balance sheet of the local transport company? If this local transport company is preparing its balance sheet, how will it report this 100 buses? Understand, it will show this as an item of PPE. What is a PPE? PPE is a tangible item that you are using in your business, right? You are using it for production or for rendering of services. So this local transport company, it is showing this buses as an item of PPE. So it is an item of PPE which is getting leased out. You get it? It's an item of PP that is getting leased out. So here when we were saying there's a lessor other than a manufacturer or a dealer, understand, they are leasing, okay, they are leasing an item of, PPE, or it can be an intangible asset. Okay. Coming back again over here. You are saying company XYZ is there, it is a need of 10 buses, okay, and it is contacting a local transport company. Instead, what this company does, it contacts Volvo, a manufacturer of buses. Okay, why should I really contact a local transport company? I'm in need of 10 buses, let's say, and we are contacting directly the manufacturer. We are asking the manufacturer that, see, you are already manufacturing buses. Can you spare 10 buses for us? We want to enter into a finance lease arrangement. So we are contacting the Volvo company, or you may contact a dealer of Volvo, doesn't matter. Basically, understand, you are contacting a manufacturer or you are contacting a dealer, and you are asking the dealer that, see, you are already selling your buses. What we want is, we want 10 buses on finance lease basis, and Volvo agrees. Volvo agrees, or the dealer agrees that fine, we are ready to spare 10 buses for you. Understand what will be the difference now? What will be the difference now? Earlier, the local transport company, when that company was sparing 10 buses for you, it was entering into a lease transaction for an item of PPE, because the local transport company is using these buses for its business. But when Volvo enters into a finance lease, it is not entering into a lease for an item of PPE. No, Volvo is selling these buses in ordinary course of business. So Volvo is entering into, or the dealer is entering into, a lease transaction for an item of inventory. Understand? PP is what you are using in your business, while inventory is what you are selling in the ordinary course of business. Volvo is not showing the buses in its books as PPE. Volvo is showing the buses in its books as inventory, because it intends to sell these buses in the ordinary course of business. So when we discuss over here, the manufacturer or the dealer, understand, when you say manufacturer or the dealer, then the manufacturer or the dealer is leasing an item of inventory, because you are planning to sell it in the ordinary course of business. And when you are leasing out an item of inventory, you have to recognize sales, you have to recognize revenue. Here you are leasing out, understand now? Okay, we are completing the entire point now. Other than manufacturer or the dealer, you are leasing an item of PPE. You are leasing an item of PPE or an intangible asset. That is the reason they are saying that you de-recognize the carrying amount of the asset. Right? That is the reason they say that you de-recognize carrying amount of asset. Why carrying amount? Because for you it is a PP, for you it's an intangible asset. So you should de-recognize the asset, remove the asset from your books, right? But at carrying amount. Here they are saying it's an item of inventory. If it's an item of inventory, you are removing an item of inventory. So you should now recognize revenue, because this is a sale transaction. You have to recognize a revenue over here. So if you will see the points now, I'm sure it will make a lot of sense, right? It will make a lot of sense. Understand? We are discussing this point again, initial measurement. They are saying for finance leases other than, okay, other than, remember now, if it is other than manufacturer or dealer, that means it's a finance lease of PP or an intangible asset. That's the reason they are saying de-recognize carrying amount of the underlying asset, remove the PP, remove the intangible asset from the books, and recognize the net investment in lease. Difference, gain or loss, recognize in the P&L. Now see this point, it will make a lot of sense now. You know, it will make a lot of sense. Initial measurement for finance lease of manufacturer or dealer. This time it is for an item of inventory. If it is an item of inventory, consider that as a sales. They are themselves using the word here, outright sales. Consider this as a sale transaction. If you say it is a sale transaction, you will have to recognize revenue. So that's the very first point, recognize as revenue. Fair value of the asset or present value of the lease payments, whichever is lower, that will become the revenue. You have manufactured an item of inventory which you are now selling. So the cost of goods sold, that should be debited. And the difference between the cost of goods sold and the revenue that you are going to receive, that's your gain or loss, which will be recognized in the profit and loss account. I hope the point is crystal clear. I hope so. And finally, once the finance lease has been initiated in your books, what to do after that? Okay, you should recognize finance income. Just as earlier we were recognizing a finance expense, isn't it? We were in the books of the lessee, we were showing ROU asset and then a corresponding lease liability. We were arguing that as if we have taken a loan from the lessor and hence we are paying interest. When you see it from the books, when you see it from the angle of lessee, there was an interest expense. When you see it from the viewpoint of the lessor, there shall be an interest income or a finance income. So this finance income needs to be recognized. Similarly, if you are receiving any variable payments which are not included in the lease payments, for example, as a lessor, I have told you that you have to give me 1% of sales. So this 1% of sales that I am receiving is my additional income. So this income naturally should be recognized in the P&L. So they say separately recognize income from variable lease payments that are not included in the next investment in the period in which that income is earned. And in case if there is any impairment, then that impairment loss should be recognized. So that's in detail that how a finance lease can be accounted for in the books of the lessor.